have Dhananjay Sinha also joining in on the show right now. Dhananjay, would you agree with Nikunj that it just shows the sheer resilience of the India equity markets, the fact that quite a few events which one would think would be carnage for markets, they've not really managed to shake them so far.
So I think the resilience in the Indian market essentially, is dependent on the fact that the expectations on growth in India is pretty optimistic. I would say people are still expecting 7% GDP growth. If you look at the earnings expectations for Nifty, it's still about 15% growth for this year, and the following year about, because there's some downgrade, roughly about 20% next year. So after a 40% expansion in earnings, expectations of a fairly robust or reasonably good growth relative to the rest of the world is still very much there. So if you look at the ranking, we look at a ranking of about 26 indices across the world. I think in terms of expectations on earnings growth, it is fairly on the top list. So I think the expectation growth is essentially holding us up in terms of the resilience. There has been sort of a flattishness of the market over the last 1.5 years. So Nifty is about 17,400 something now. I think 1.5 years back it was similar levels. So I think it has just stuck around there. Whereas let's say the US markets have corrected, etc. So that is the thing. But what we have to really look at is whether the so if you look at the valuation in this 26 indices that we're looking at, India would be lowest in terms of relative valuation. So it's very rich in terms of relative valuation. Yeah, about 50% higher than the average in terms of the average PE ratio that we're looking at. So I think any miss with respect to earnings expectation for the cuts in earnings in a context where global rates are going up, I think, and there can be a downside risk to valuations, and along with expectations of fairly, reasonable cuts in expectations in expected earnings going forward. So we are expecting about 15 to 20% cut this year. In FY23, Nifty earnings have been cut by about 10%. For non-finance companies, it has been cut by about 16 odd percent. So banking sector is something that has up counterbalance the non-banking sector. But my sense is that going forward, the banking sector could be at risk in terms of the
Right.
earnings expectation.
Speaking of the banking sector as well, this week it's shaved off about 2% or so, but it's been real estate that has been the hardest hit for the week gone by, at least 3.6%. IT has lost out about 1% for this week, while energy has been the sole sector that's managed to eke out gains in the week gone by with a close to 1.8% return. But interesting names as well on the charts, and Arpit Beriwal is joining in as well on the technicals. Maruti has seen a smart recovery from the low point of the trading day, clutching onto the 8,600 mark. There's Cipla as well that has managed to bounce back, something like a Shree Cements as well as a notable pullback. Arpit, let's get in your take on these three stocks.
Yeah, very good afternoon. So first talking about Maruti. So Maruti overall, the auto sector has been sideways for many weeks. Now talking about Maruti. So Maruti overall, it has on a weekly scale, it has been sideways between 8,400 to 8,800. Now it is again taking support near 200 DEMA. So overall, look on the chart structure, the upside is cap, but on the downside, 8,300 is a major support, whereas on the upside, 8,850 is a major resistance.
Okay. Dhananjay, when you say that earnings are not looking that, and earnings risk is there, but last 2 quarters only earning cuts have started. So some would say the fact that earning estimates are getting revised on the downside, it is something which is an ongoing process. It has already started 2 quarters ago.
Yeah. I think when we expected earnings to be cut, it was last year. And we are talking about February of 2022. We were saying that the projected earnings for Nifty would be cut by about 15%. And we have seen that it is in the process. So if you look at the analysis of quarterly results that we have done at an aggregate level and at sub-sectors level, we have seen that what is noticeable is that most of the indicators are to fall. If you look at beyond the Nifty, set of companies, you look at larger companies of over 2,500 companies that we've looked at. What we found is that the absolute level of sales have actually started to fall, not just for the commodity sector, but across multiple manufacturing sectors. That is translating into a lower utilization of labor costs of raw material and such as for taxes, depreciation, etc. If you look at that, all those things have actually to fall. But what is also happening alongside is there is a sort of 30% growth in interest costs. I think the whole deleveraging that we were talking about after the COVID and post-pandemic, I would say the bounties that we got is actually reversing. So you have a scaling down of operations and rising interest costs having a significant impact on the profits. So the profits have also contracted both at the operating profit levels and also at the net profit level. So I think that's a very important thing to really look at. We are saying that this thing might actually continue going forward because companies will start to focus on productivity, efficiency, margins,
Dhananjay,
etc.
we're getting a slight trouble with your audio. I'm just going to get back to you and get that sorted. Let's just take a look at what the market is settling in at, because clearly while banks are taking a tumble, we're now down 190 points. So a feeble attempt at a recovery, considering that we were, much worse previously in the day. 1% lower is where we're currently at, and the spot Nifty has managed to resurrect itself back at that 17,400 mark. Tata Motors clearly is your big winner today. There's BPCL also, which is holding out. ITC has somewhat now flattened out and it's covering. That stock is relatively resilient. Bajaj Auto, Unilever, Britannia, although one must say that these are not your high-weighted stocks for sure. But yeah, so far they're looking okay as opposed to the rest of the market. But deposit growth is not moderating. That's the word coming in from the HDFC Bank CFO, Srinivasan Vaidyanathan. In his first TV interview ever, he remains pretty optimistic about growth prospects. Let's listen in.
So before I come on the retail part of the loan book, I want to understand how is the corporate end of the loan book behaving in terms of their behavior towards fresh credit, be it your SME kind of book, rural book, and of course the corporates. Because the fact of the matter is that rates in the system have edged higher, and from now also it likely to edge higher. So what kind of conversations are you having?
The larger the corporates, they come with the rate view, because professionally managed money managers who are there in the corporates, so they have quite a view of where the market is heading, the rates are heading, and so there's intense discussions that will happen in terms of the credit. But working capital is something, as I said, is inevitable and people have to finance. And from a project financing, it takes time, over a period of a longer term it comes. But good demand on that front, and people, it is not as interest rate sensitive from a working capital credit offtake, because ability to pass on is important, and that happens at both the SME level as well as on the wholesale level. People are able to pass it on. So that's, and then when they pass it on, does it impact the consumer spending at the end? It is reflected in the price of the goods and services at the end. Is it reflected there? It is. Does it matter? Does it matter to the overall economic growth? It hasn't. India is a high interest rate country for most part, right? Operating at a 6% to 8% kind of an interest rate is not something that is new in the country. Over a longer period of time, that's something we have seen that. And over this kind of period during those interest rate regime, the growth rate has also been very robust. Sure. And so that's part of how the economy has been functioning very well.
You have a very large part of your loan book now on the semi-urban and rural side as well. And there's again and again this argument coming on the table that there's a K-shaped recovery in the economy. Perhaps the lower end, inflation and higher rates both have been pressurizing the lower end of the customer or consumer. What are your thoughts on rural and semi-urban smaller ticket?
See, it is absolutely right that the K-shaped recovery is something that is visible and one sees that. But our banking customer target segment is above certain customer segment level. So we're not experiencing directly that particular segment which is impacted. It is true that inflation disposable incomes are less at the lower levels. So that is part of the impact which is there. And coming out of the COVID, the most impacted customer segment from COVID was that segment, where the jobs were less, or daily earners or the weekly earners, so the impacted people who are there. So now coming out of that, whereas even in the semi-urban and rural that you alluded to, where 60% of the country is, our target segment is not all of that 60% of that rural India which is there. We are interested in the top 20-30% of that 60%.
Okay.
That is our target segment, which means the top end of that segment in the rural, semi-urban and rural, where they continue to have good disposable incomes and cash flows.
So we saw that in the quarter gone by, your interest income, there was a 13-quarter high kind of growth. And now people are also, though a lot of shareholders who have logged in, because there was a very long wait also, the stock did not do very well in numbers. So people who are patient are getting rewarded now. But they're also kind of little worried, can this growth rate sustain? You see any reason to of that question or worry arising, or up till now the visibility is that it may sustain?
See the visibility in terms of what I would, rather than look forward to say where it is, I will look backwards, is to say that as a bank we have consistently performed in terms of having a balance of various products across segments, right? That suits the products are there that suits the economic growth across various segments.
That's the view coming in from HDFC Bank. Moving right on, just checking in on some of the interesting movers for the week gone by. It's of course Adani Group stocks that dominate that list, but that aside, JSW Energy has shot up about 11% or so. There's been Max Healthcare that's been in the limelight on the upside for the week gone by. Power Finance Corp, Hindustan Aeronautics, GAIL, and even something like a Cummins India has seen traction. Let's get in a view on the charts. Kunal, HAL, GAIL India, JSW Energy, what do the charts look like?
So I think HAL is looking very, very attractive on the charts. The stock made I think a fresh 52-week high just about a few days back, bouncing off exactly from its 200 moving average. So that was a sign of strength coming back for HAL. From the other names that you mentioned, some of the stocks which I've been liking from the defense pack have been BEL, for example. That stock has been more sideways. JSW Energy, and that's a very interesting stock because from 2020, the stock which was at 2 digits, I think 67, 77 approximately, moved up very, very quickly towards the 300 plus 300, 400 zone, and then from there on the stock has gone to a time-wise as well as a price-wise correction. So I think it's a good opportunity to try and look at even accumulating JSW Energy from a more medium term to long term scale.
Time for those BTST trades then, and let's find out what exactly our chartists are picking out for the day. Kunal?
So I'll go with a couple of buy calls from the stock specific front. So two buys. First one is one Aster DM, the stock forming a triangular pattern breakout very close towards the breakout point. So would anticipate the breakout targets of 248. Stop loss could be kept at 224. And Bector Foods has been one of the stocks which I've been recommending over the last 1.5 odd months. Looks very attractive on the charts. Made a fresh 52-week highs today. So would suggest a buy. Targets of 600. Stop loss at 544.
All right. Watch out for some of those interesting recommendations. Arpit, let's get in your BTST trades.
Yeah, so we have one buy side and one sell side. So within buy side, we have the NTPC. So talking about the NTPC chart, the monthly and weekly setup is quite strong. It has given a daily breakout above 177 levels, and we're expecting 3 to 4% upside move. So at current level, one can buy with keeping stop loss of 176 for an upside move towards 187. Whereas on the other side, we have a STPT trade on Lal Path Labs. So looking at the overall chart structure, it is on a downtrend. Monthly and weekly setup is quite weak. Daily it has given a fresh consolidation breakdown. So till it holds below 1880, we can expect downside towards 1760. So one can short at current levels with keeping SL of 1870 for a target towards 1760 levels.
We're revisiting some of the Path Lab stocks. They were like the real heroes, and now the tide has really, really reversed. Actually, look at Dr. Path Lab, Thyrocare. I can throw in a Metropolis. They're off what, Kunal? 30, 40, 50%, right?
In fact, from 4,200, for example, Lal Path Labs, it's at 1,800.
More than 50%.
More than 50% is a correction.
Thyrocare, the company was acquired at, I think, 1,300 rupees.
Correct. 1,400 rupees, and now the stock is at 478.
And what about Metropolis?
How well timed.
So
He got a clean
Mr.
exit.
Velumani
Mr.
really got it
Velumani got a
right.
clean exit. I mean, he really mastered the art of. See, any businessman who's not emotionally attached to the business is in the business of creating a business and then selling at the right price. So he sold Thyrocare at a price at which that price has not come again. However, he also invested his personal money in PharmEasy, the company which was supposed to go public. And then we know the company which has acquired Thyrocare is not going public. So on a personal front, while he got 2,000 crore cash, another 2,000 was also put in the stock of PharmEasy. That time it appeared that these NetMeds and the PharmEasys of the world will go public because everything was getting digital, from Sabjiwala to Dawaiwala, everything was getting digital because that was the COVID time. Now the realization has cut in. I think what's happened with Thyrocare and the Dr. Path Labs of the world is that there was a COVID rush and everyone thought, okay, COVID rush is something which is going to remain permanent. Then the assumption was that, okay, COVID RT-PCR rates are capped. So there is no upside which you will get even if COVID tests go away. But what people don't realize, or what a lot of Janta did not realize, was that along with an COVID RT-PCR test, you were doing also some other test. Those were the tests where the price cap was not there. And I guess that is the most important, aspect, so to speak. 2 minutes to go for the market to close. And we just about, there you go, there you see. The price of Thyrocare, it's just been a complete disaster, so to speak. Dhananjay, before we wrap the market, would you be now a contra buyer in any of the diagnostic stocks?
I would still wait. I would say that, I think a lot of correction has happened. And I think, as you are right, I mean, you have said it, I think the whole, pandemic bounce that was there, that has actually gone away. I think, we are sort of looking at the healthcare space and now because of the valuation that has happened, I mean, the valuation that has emerged. So we will start nibbling into the pathology space, as you mentioned. One can consider this. Yeah.
Okay.
Okay, let's begin winding up for the day. Dhananjay, good to have you with us. Kunal,